This video documents comprehensive research analyzing 8 major stock market crashes spanning 50 years from 1970 to 2024, identifying patterns, common investor mistakes, and strategies that actually protected wealth during downturns. Opening with the stark reality that most investors lose money in crashes not because they're invested but because they panic, sell at bottoms, make emotional decisions during volatility, or lack defensive positioning before crashes hit. Promising complete transparency showing data from every major crash: 1973-74 oil crisis recession, 1987 Black Monday, 2002 dot-com bubble, 2008 financial crisis, 2020 COVID crash, 2022 inflation crash, plus smaller 1998 and 2011 corrections. What happened to different asset classes? Which strategies actually protected capital? Which didn't, despite conventional wisdom? And practical lessons applicable to individual investors preparing for inevitable future downturns. Comment READY. If you're prepared for the next crash, scarred if you're not. The Crash Catalog establishes historical record documenting crash for 1973 showing S&P 500 declining 48% over 21 months from January 1973 to October 1974, caused by oil embargo, stagflation, high inflation, high unemployment, dollar devaluation from gold standard abandonment, with average stock taking 7.5 years to recover to previous highs, demonstrating brutal, prolonged bear market where buy and hold suffered severely. Crash 2. The 1987 Black Monday showing S&P 500 plunging 20.5% in single day on October 19, 1987, then 33.5% total from August peak to December bottom, caused by program trading, portfolio insurance selling cascade, overvaluation concerns, with recovery being surprisingly fast, reaching new highs by July 1989 to 21 months, demonstrating that crash severity not predicting recovery timeline. Crash N3. 1991 Gulf War recession showing S&P 500 dropping 19.9% over 3 months from July to October 1990, caused by Iraq invasion of Kuwait. Oil price spike to 40, recession fears, with recovery being very rapid, reaching new highs by February 1991, 4 months, demonstrating geopolitical crashes typically being short-lived. Crash When 4. 1990 Asian-Russian crisis showing S&P 500 declining 19.3% over 2 months from July to August 1998, caused by Asian financial contagion, Russian debt default, long-term capital management collapse, with extremely rapid recovery reaching new highs by November 1998, so 3 months, demonstrating liquidity crises being quickly resolved by central bank intervention. Crash FI 2002 dot-com bubble showing Nasdaq collapsing 78% over 31 months from March 2000 to October 2002, while S&P 500 declined 49% over similar period, caused by internet speculation, unprofitable company overvaluation, revenue, multiple insanity, with brutal prolonged recovery where Nasdaq taking 15 years to recover to 2000 peak, until 2015, while S&P recovering in 7 years, 2007, demonstrating sector-specific bubbles producing decade, plus lost periods. Crash Fate 6 2008 financial crisis showing SP 500 plummeting 57% over 17 months from October 2007 to March 2009, caused by subprime mortgage collapse, banking system insolvency, credit market freeze, global financial system near collapse, with recovery taking 5.5 years, reaching new highs by March 2013, demonstrating systemic financial crisis producing severe prolonged damage requiring years of recovery. Crash Fan 7 and 2020 COVID crash showing S&P 500 dropping 34% in just 33 days from February to March 2020, representing fastest crash in history, caused by pandemic shutdown, economic uncertainty, earnings collapse fears, with shockingly rapid recovery reaching new highs by August 2020, 5 months, demonstrating unprecedented monetary fiscal stimulus can produce V-shaped recovery defying historical patterns. And Crash High 8A 2022 inflation crash showing S&P 500 declining 25% over 9 months from January to October 2022, while bonds simultaneously falling 60-40, portfolio having worst year since 1937, caused by Federal Reserve aggressive rate hiking to combat 9% inflation, tech valuation compression, recession fears, with recovery beginning November 2022 and new highs reached November 2024's 24 months, demonstrating inflation fighting crashes affecting both stocks and bonds, creating nowhere to hide environment, totaling 8 distinct crashes with varying causes: monetary, geopolitical, speculation, systemic, pandemic, inflation, severities, 19% to 78% declines, and recovery timelines 3 months to 15 years, providing comprehensive dataset for pattern analysis and lesson extraction. Which crash would have destroyed your portfolio? Comment the year. The pattern analysis reveals 5 consistent findings across crashes where pattern way 1. Stocks always recover, but timeline varies dramatically. Shows 100% of crashes eventually recovering, with S&P 500 reaching new all-time highs after every single downturn, but recovery timeline varying from 3 months, 1998 to 7.5 years, most 1973-74, with average recovery being 3-4 years, teaching that stocks always recover, being true but meaningless without timeline context since 7-year recovery requiring extraordinary patience and many investors unable or unwilling to wait. Pattern. Buying the dip works. If you can stomach continued falling, shows investors buying during crashes eventually being rewarded handsomely, with those buying S&P 500 at any point during 2008 crash earning 400% plus over the next decade. Those buying during 2020 COVID crash earning 100% in 4 years, demonstrating dip buying working long-term BUT requiring psychological fortitude to buy while falling. Endure continued declines, many crashes having multiple bottoms before true bottom, and stomach 30-50% paper losses before recovery, with data showing most retail investors selling not buying during crashes despite intellectual knowledge that dip buying works. Pattern weight 3A. Diversification helps, doesn't eliminate pain. Reveals traditional 60k 40 stock bond portfolio reducing, but not preventing losses, where in 2008 crash 640 declining 30% versus fee 7% for 100% stocks, a 46% loss reduction. In 2002 crash 60-40 declining 18% versus 49% for 100% stocks, 60% loss reduction, demonstrating bonds providing cushion during equity crashes making pain more bearable. BUT 2022 proving exception, where 60-40 portfolio declining 18% with stocks and bonds falling simultaneously, demonstrating diversification, not being panacea and working only when assets uncorrelated. Sector rotation creates massive performance divergence, shows different sectors performing dramatically differently during crashes, creating opportunity and danger, where in 2002 tech crash NASDAQ falling 78% while utilities, consumer staples, healthcare rising or falling minimally. In 2008 financial crisis financials falling 80% while healthcare, consumer staples falling only 20-30%. In 2020 COVID crash travel energy, retail falling 50-70% while tech healthcare falling only 10-20% then recovering rapidly, demonstrating sector-specific crashes destroying concentrated portfolios while broad diversification across sectors, reducing but not eliminating damage. And pattern wine FIVI. Timing the bottom is impossible, but buying near bottom creates generational wealth, reveals that nobody times exact bottom. March 2009, March 2020, October 2002, but buying anywhere near bottom within 20% of bottom producing extraordinary returns, where buying S&P 500 within 20% of March 2009 bottom, so between March 2009 and January 2010, generating 500% of returns over next 15 years, buying within 20% of March 2020 bottom producing 100% returns in 4 years, demonstrating exact timing being impossible, but approximate timing during maximum fear and capitulation creating life-changing wealth accumulation for those with capital and courage, totaling 5 patterns showing recovery certainty, dip buying opportunity, diversification value with limits, sector importance, and near bottom timing creating generational wealth despite timing impossibility. Be honest, would you have bought stocks in March 2009 or March 2020? Comment yes or no. The Investor Mistake Catalog identifies 7 deadly errors consistently destroying wealth during crashes where mistake by 1. Panic selling at or near the bottom. Shows majority of retail investors selling not buying during maximum fear, with data showing record retail investor outflows occurring March 2009's exact bottom of 2008 crash, March 2020 exact bottom of COVID crashed, October 2002 near bottom of .com crash, demonstrating investors systematically selling at worst possible times driven by fear, pain aversion, media negativity creating wealth destruction by locking in losses permanently. Mistake bite 2A. Over concentration in high flying sectors before crash reveals investors over allocating to whatever sector performed best, recently getting destroyed when that sector crashes, where 2000 investors having 60-80% tech allocation getting annihilated when tech falling 78%. 2008 investors overweight financial suffering 80% to losses. 2020 investors overweight travel energy experiencing 57% declines, demonstrating recency bias and greed driving dangerous concentration in previous winners creating catastrophic losses when sector crashes. Mistake when 3. Using leverage or margin especially late in bull market, shows leverage positions facing forced liquidation at bottoms, where margin calls forcing sales at worst prices, with 2008 showing numerous hedge funds, investment banks collapsing due to leverage. Bear Stearns, Lehman Brothers, retail investors losing entire accounts from margin calls, demonstrating leverage amplifying gains in bull markets, but creating total wipeout in crashes as forced selling at bottoms eliminates recovery possibility. Mistake wine 4. Ignoring valuation metrics when they reach extremes, reveals buying at extreme valuations guaranteeing poor returns, where investors buying tech stocks at 100x revenue multiples in 2000 experiencing 78% losses, buying homes at AX income ratios in 2007 leading to 2008 collapse, buying SPES and unprofitable tech at absurd valuations in 2021 causing 22 crash, demonstrating that extreme valuations always mean revert and buying at peaks guaranteeing negative returns even if asset class eventually recovers. Mistake 25. Failing to rebalance portfolio during bull market run-ups shows portfolios drifting from target allocation during bull markets, creating dangerous exposure where investors starting with 60/40 stock bond portfolio experiencing stocks rising 3x over bull market ending with 80/20 allocation unintentionally, then crash affecting 80% not 60% of portfolio, creating much larger loss than planned. Demonstrating drift during bull markets, increasing risk beyond tolerance plan, making crashes more painful than necessary. Mistake 86C. Timing the market by going to cash then missing recovery